Estate tax versus income tax. Have you ever wondered how estate tax and income tax differ? Understanding these taxes is essential for effective estate planning. Let's break it down in simple terms. Estate tax is a tax on the transfer of assets when someone passes away. It applies to the total value of the deceased person's estate, which includes cash, real estate, investments, and other property. For the year 2025, the federal estate tax exemption amount is $13,990,000 for individuals. This means that if an estate is valued below this amount, it will not be subject to federal estate tax. For married couples, the combined exemption is $27,980,000. Any value above these exemptions is taxed at rates that can go up to 40%. This tax is paid from the estate before any assets are distributed to heirs, which can affect how much they ultimately receive. On the other hand, income tax is a tax on the money earned by individuals or entities during their lifetime. This includes wages, salaries, interest, dividends, rental income, and capital gains. Income tax is assessed annually based on taxable income and is subject to progressive tax rates that vary depending on how much money you make. Unlike estate tax, income tax continues throughout a person's life and applies to income generated by assets. The timing of these taxes is a key difference. Estate tax is triggered by death and is based on the estate's value at that moment. In contrast, income tax is calculated every year based on income earned during life. Another distinction is the tax base. Estate tax focuses on the net value of assets transferred at death, while income tax is based on earnings and gains realized during life. The exemptions also differ significantly. Estate tax has a high exemption threshold, affecting only larger estates, while income tax applies to nearly all income earners. From the perspective of estate planning, knowing these differences is important. Effective strategies can help reduce estate tax exposure, such as making lifetime gifts or establishing trusts. Recent tax law changes, like the permanent extension of the higher estate tax exemption under the One Big Beautiful Bill Act of 2025, provide more stability for planning. This law maintains the exemption at $15 million per individual, adjusted for inflation, and keeps the top tax rate at 40%. In summary, estate tax is a one-time tax on transferring assets at death above a high exemption amount, while income tax is an ongoing tax on earnings during life. Both taxes play a role in wealth transfer and preservation, but operate differently in timing and calculation. Understanding these distinctions is essential for effective estate planning to protect assets and minimize tax burdens on beneficiaries.